Just wanted to give you an overview of what we've been talking about for weeks and actually a few months now, that this strong likelihood that we're going to see a dark window scenario. And this has happened many times before. And the most extreme was between late 98 and early 2000 when the tech stocks, the NASDAQ, saw a final blow-off rally led by the internet stocks. Just when there was a deep 34% correction in the tech stocks, and it looked like it was over in late 98, and we had this one blow-off. And that was the strongest in history. And this bubble has been so strong that I don't expect that to repeat. But I do expect that it still looks like we're going to see that one more blow-off rally. And it started with this correction into December. This was the first 20% plus. It was 24% for the NASDAQ, but more like 20% for the other key indices. First 20% deeper correction we've seen since late 2013. So that started to give the bears some momentum, like, oh, yeah, maybe this bubble had burst. But I commented early on, the September, October tops in stocks did not look like a bubble blow-off top. January 2018 did, but that was not followed by what I first looked for after studying bubbles so intensely in the last several years, is that bubbles tend to burst initially with a 42% on average sharp correction in 2 to 3 months, 2.6 on average. That didn't happen in the follow-through in February correction and March, and it didn't happen after the top in September, October into December. It was already clear we did not correct enough to be saying, oh, this is looking like the beginning of a crash. No, it's looking more like the final correction like we saw in late 98 in the last major bubble. And it's happened in many bubbles before. So now we come January, February, very strong rally up. I mean, we're only 6-7% off the highs in many indices, correcting most of this 20% plus correction. Now, first of all, bear market rallies are always severe and strong. That's what makes them so tricky. You get everybody short, and then those shorts have to cover, so they're particularly treacherous. So this could have been a bear market rally, but this has gone far enough and held up strong enough. Stocks have been they got overbought right off in early January from that late December low, and have stayed overbought for a month and a half now into late February. That's a sign of strength. The markets have gotten one thing they've been looking for. They were looking for the Fed to back off this just automatic raising interest rates a quarter every meeting and automatically selling $50 billion of bonds every month. The Fed backed off. Of course, the markets like that. That means, they're not taking us off the crack so quick. The markets on crack want crack above fundamentals in the economy. Now, I commented recently that the reason the Fed did that, which is a little bit overlooked, Europe, Italy falling into recession, Germany near recession, Europe growth slowing, China has been slowing. The world is slowing. We're the only country going to new highs in markets in late 2018. The only country that's doing as good or better than it was, and that is already projected to wear off by most economists. And very few people see 2019 as strong as 2018. And I've showed in a number of articles that the money that the companies got from tax cuts is not going into increasing capital spending. It's going into buying back stocks at record levels of $1 trillion a year now versus $600 billion, which was very high in the past. This keeps the bubble going. The second thing, the market is held up, even despite some bad news here, because they're waiting for the China deal. There seems to be some progress, and Trump keeps saying, things are going well. That may or may not happen, but the markets are holding out for that. And if we get that China deal, that's another reason the markets could keep running for a while. Now, the third thing I'm picking up on, and I think the markets are picking on this, China keeps having bubbles, in real estate. Then they encourage bubbles in stocks to take the heat off of that. And then they have to cut back on that and encourage real estate again. China's playing whack-a-mole trying to keep a out-of-control bubble under control. And so their economy's been slowing a little too much, so they're showing signs of reflating their economy this year. That's another plus, even though it's not a good thing in the long run any more than quantitative easing and tax cuts when businesses at the highest profits in history are either. All of this is a big bubble, a big mistake. Everybody in government, Fed, now Trump is doing everything possible to keep this bubble going, because when it burst, as my research shows, and it's obvious to anybody who looks at history, they burst badly. And again, half of the 70, 80, 90% crash comes in that first 2 to 3 months so fast that nobody catches it except the smart money. So this correction, I mean, we are due for a correction. The markets do not want to correct until they see what's happening on this China deal. If the China deal fails, you will definitely get a correction. If it's just mamby-namby, you will. But this market is going to correct at some point. I think sooner than later. It's overdue. That correction is going to be important. We're going to be watching this, because if we only retrace maybe a third or a half of the gains we've made since December, that's very bullish. That's saying this is the first wave up of 3 in this dark window, and it has been sharp and it has been substantial. Now, also, and I showed a week or two ago in the 5-day forecast that we could be having a declining bearish wedge about to play in. That could send us to a new low and even a substantial new low. Now, if we get just a minor new low, that is still bullish to me. That will not break the 2,300 line in the sand back to 2009 uptrend for the S&P 500, and even lower the NASDAQ, which is the lead bubble and the most important to monitor, at 5,500. We could drop to a substantial new low in the NASDAQ and still be in this dark scenario window, just like 98 going into 99. So what would be troubling if we broke first the S&P line in the sand and then the NASDAQ. So we'll be watching for that. That scenario to me now, with the strength of this game and how well it's held up, I think more of a retracement of this. I think this looks more like the first wave up. I am going to show if this pattern continues to play out in the 5-day forecast on Monday, so subscribers look out for that. A second scenario, not the declining wedge to new lows, but a scenario where we have a reverse head and shoulders pattern that would project new highs in the markets probably by April or May. So I think important thing here, everything that has happened still confirms more the dark window scenario. One more blow-off rally that could take the NASDAQ to 10,000 if December lows hold. Even if we make new lows, still to 9,400. The Dow could go to 33,000. Nobody's going to be expecting this. And that's a good reason for the market to do this. Also by April, if we see substantial new lows and start to break those lines in the sand, then we could be in the opposite. We could be in this rolling bear market scenario, which I gave in the January boom and bust newsletter. So keep referring back to that January boom and bust. The rolling bear market, more like 2007 into 2008. I never thought that was the most likely scenario, because this would be the peak of a major bubble, not a minor bubble like 2007, more like 2000 or 1929 or the Nikkei bubble in 1989. And that should be more dramatic. It shouldn't be a rolling bear market. And again, September, October didn't look like a bubble top. So again, we'll be looking at the next correction. It is going to come sooner than later, probably. And we're going to be on this and keep you updated. But things look good. We may get incredible profits in stocks before we get the opportunity to get into long-term high-quality bonds, people to hedge their portfolios with very cheap options, and even to maybe bet a bit on the downside, depending on your risk tolerance. This is going to be perhaps the most profitable period any of us will face in our lives, upside and downside. That's where our trading services in this volatile period, in this winter season that's being thwarted by massive stimulus, but it's still the winter season and nature will win here. You have to have investment systems that can make money in the upside and the downside, because volatility is the name of the game, at least into 2022 and perhaps farther. And we're set to play that. And I hope you are too.